Welcome back to the Deep Dive. Today we're tackling a form that's really foundational for a specific kind of business structure in the U.S. Form 1120-S, that's the income tax return for an S corporation.
That's right. And we've got the source material right here, the actual 2024 form and well, pretty hefty instructions that come with it. Our goal today is to cut through all that complexity.
Yeah, it looks dense.
It is. But we want to pull out the key concepts, the really essential details you need to understand what this form does and what it tells us about how an S Corp works financially, especially for tax purposes.
So think of this as your essential guide, pulled straight from the official IRS documents. Let's dive in and unpack this thing.
The essentials of Form 1120-S.
Okay, so first things first. What is Form 1120-S for? Well, fundamentally, it's the tax return used by a regular domestic corporation, or sometimes another entity, that has specifically elected to be treated as an S corporation for federal tax purposes.
Right, that S selection is key.
Absolutely. And this form is where that S corp reports all its financial activity for the year, its income, gains, losses, deductions, credits, all the relevant tax information.
And who has to file it? Is it automatic if you're incorporated?
No, not automatic. The instructions are very specific. An entity must file Form 1120-S if 1. It elected S corporation status by filing Form 25533, 2. The IRS actually accepted that election, and 3. That election is still in effect for the tax year you're reporting.
So you can't just decide you're an S Corp and start filing this form?
Definitely not. There's a big caution in the instructions. Do not file Form 1120-S unless that S election is properly in place, or you are attaching Form 2553 with the return, usually because you're requesting relief for a late election.
Okay, so making that election using Form 2553 is step 1. How does that timing work?
Generally, the rule is pretty tight. You have to file Form 2553 no more than 2 months and 15 days after the beginning of the tax year the election is supposed to take effect.
That's not a lot of time.
It isn't. And if you try to file the 2553 with your first 1120-S, well, that's generally considered a late election. Now, it's not necessarily fatal. The instructions for Form 2553 do mention that you can request relief for filing late.
Okay.
But you need to show reasonable cause for missing the deadline. It's not automatic approval, but there is a path if there was a legitimate reason.
Got it. So assuming the election is properly made and accepted, when is the actual Form 1120-S due?
The standard deadline is the 15th day of the third month after the end of the corporation's tax year.
So for most S Corp, they're on a calendar year,
Yeah.
ending December 31st. Third month after that, March, so March 15th.
That's the base date. But like with individual returns, if that date falls on a Saturday, Sunday, or legal holiday, it gets pushed to the next business day.
Okay. And for the 2024 return, filed in 2025, March 15th, 2025 is a Saturday.
Exactly. So the instructions point out that the actual due date for the 2024 calendar year return is Monday, March 17th, 2025.
Good to know. What if the corporation shuts down mid-year?
There's a rule for that, too. If the corporation dissolved during the tax year, its final return is generally due by the 15th day of the third month after the date it dissolved.
Makes sense. Now, where do you actually mail this form? I remember hearing it depends on where you are.
It does, and it also depends on the S corp's size, specifically its total assets. The instructions have a chart. For example, if your main business location is in, say, New York, and you have less than $10 million in assets, and you're not required to file Schedule M3.
We'll get to M3 later, I assume.
We will. But in that case, you'd file with the IRS Center in Kansas City, Missouri. But if that same New York company had $10 million or more in assets, or if it was filing Schedule M3 even with less than $10 million, then it goes to Ogden, Utah.
And for other starts like, say, California or Texas?
For a whole list of other states, including those, the instructions just say file in Ogden, Utah, regardless of the asset size. And if your main business location is outside the U.S., in a foreign country or a U.S. territory, there's also a specific address in Ogden.
So, bottom line, check the chart in the instructions carefully based on your state and asset size.
Absolutely critical. Don't just guess.
Okay, form's filled out, ready to go. Who signs it?
It needs to be signed and dated by an authorized corporate officer. The instructions list the typical roles: president, vice president, treasurer, assistant treasurer, chief accounting officer.
The usual suspects.
Right. Or it could be any other officer who the corporation has specifically authorized to sign tax returns. Now, if the corporation is in some kind of receivership or bankruptcy, then the receiver, trustee, or assignee signs, and they have to attach a copy of the court order that gives them that authority.
And what about paid tax preparers?
The instructions mention they can use various signature methods, including mechanical or digital ones, following specific IRS procedures.
And there's that little checkbox near the signature area, the paid preparer authorization. What does checking yes there do?
Checking yes gives the IRS permission to talk directly to your paid preparer about certain aspects of processing the return. It's not a full power of attorney, but it lets the preparer, provide missing information if the IRS calls, check on the status of the return or refund, and respond to certain notices about math errors or things related to how the return was actually prepared.
So it can potentially speed things up if there's a small issue during processing?
That's the idea. It's designed to be a more efficient way to handle those routine processing questions.
How about paying taxes? Do S-Corp just mail a check?
Generally, no. Like most businesses now, S corporations are usually required to make their federal tax deposits electronically. This covers employment taxes, excise taxes, and any corporate income tax they might owe, like the built-in gains tax we'll discuss.
And how do they do that electronically?
The main system is the Electronic Federal Tax Payment System, or EFTPS. It's a free service from the Treasury Department. You can enroll online at eftps.gov or call them.
Is there a deadline for using EFTPS?
Yes, and this is important. You need to initiate the payment through EFTPS no later than 8 p.m. Eastern Time on the day before the tax due date for it to be considered timely.
So you can't wait until the actual due date. Got to plan ahead.
Exactly. If you miss that EFTPS deadline, there is an option for a same-day wire payment through the Federal Tax Collection Service, but you need to make arrangements with your bank beforehand, and there might be fees involved. IRS.gov has info on that under same-day wire.
Do S-Corp typically owe income tax? I thought the point was pass-through.
Mostly pass-through, yes, but S-Corp can owe tax directly in specific situations, like the tax on built-in gains if they were previously a C-Corp, the excess net passive income tax, again related to C-Corp history, or investment credit recapture tax. If they expect to owe $500 or more in these specific taxes, they need to make estimated tax payments throughout the year, also electronically.
Okay. And if things go wrong? Late filing, late payment. What are the consequences?
The instructions lay out the penalties pretty clearly. First, interest is charged on any tax not paid by the original due date, even if you got an extension to file. Interest also applies to penalties if they aren't paid on time.
So interest is almost automatic on underpayments. What about specific penalties, like for filing late?
Yes, there's a late filing penalty. If you file late without reasonable cause, or if the return is missing required information, a penalty applies. Now, if there's no tax due on the return, the penalty is calculated per shareholder. It's $245 for each month, or part of a month the return is late, for up to 12 months. And that $245 is multiplied by the total number of people who were shareholders at any point during the year.
Wow, $245 per shareholder per month, even with no tax due. That could add up fast.
It really could, especially for S-Corp with many owners. Now, if tax is due and you file late, the penalty is that $245 per shareholder amount plus 5% of the unpaid tax for each month or part of a month, up to a maximum of 25% of the unpaid tax.
And there's a minimum penalty for being really late.
Yes, for returns due in 2025, if you're more than 60 days late, the minimum penalty is the smaller of $510 or 100% of the tax due.
Okay, that covers filing late. What about paying late?
The late payment penalty is generally 1/2 of 1%, 0.5% of the unpaid tax for each month or part of a month the tax remains unpaid. Again, this is capped at 25% of the unpaid tax. This penalty might be waived if you can show the failure to pay was due to reasonable cause and not willful neglect.
And S-Corp have to send out those Schedule K-1s to their shareholders. Are there penalties tied to that?
Absolutely. Failure to furnish a correct Schedule K-1 or Schedule K-3 if needed to a shareholder by the due date carries a hefty penalty. $330 per incorrect or missing K-1.
Per K-1. Ouch.
Yes. And if the IRS determines that the failure to provide correct information was due to intentional disregard of the rules, that penalty jumps significantly. Could be $660 per K-1, or even 10% of the aggregate amount of the items required to be reported correctly, whichever is greater. So getting those K-1s right and out on time is crucial.
One last point on penalties if you think you have reasonable cause. When do you explain that to the IRS?
The instructions advise not to attach an explanation to the return when you file it. Instead, wait until the IRS sends you a notice proposing the penalty, and then respond to that notice with your explanation and supporting documentation.
Page 1, Business Income and Deductions.
Okay, let's get into the nuts and bolts of the form itself. Page 1 seems to be where the main business action happens, and the instructions start with a big warning sign, a caution.
Yes, and this caution is fundamental. It tells you that lines 1A through 22 on page 1 are only for reporting income and expenses related to the S corporation's trade or business activities. Things like investment income, portfolio income, or certain deductions that get special treatment don't belong here. They go elsewhere, primarily on Schedule K for pass-through to shareholders.
So page 1 is purely the operational side of the business sales, cost of goods sold, operating expense.
Exactly. Keep that distinction in mind. Trade or business on page 1, other stuff generally on Schedule K.
All right, let's look at some key deduction lines, say lines 7 through 20. Line 7 is compensation of officers. This sounds important for S-Corp.
Extremely important and often scrutinized by the IRS. The instructions are very clear. Any distributions or payments the S-Corp makes to an officer must be treated as wages, subject to employment taxes, but only up to the amount that represents reasonable compensation for the services that officer actually performed for the corporation.
So you can't just pay yourself zero salary and take everything as distributions if you're actually working in the business.
Correct. The IRS expects shareholder employees who provide significant services to receive a reasonable salary first, before any profits are distributed. Determining what's reasonable depends on the facts, duties, time spent, comparable salaries, but it's a mandatory consideration. The rest of the profits can then be distributions.
Okay. Line 8 is salaries and wages for everyone else, less any employment credits. Pretty standard. Line 9, repairs and maintenance. Any catches here?
The main distinction is between deductible repairs and non-deductible capital improvements. Routine maintenance to keep property working. Generally deductible here. But expenses that significantly add value, prolong the life of the property, or adapt it for a new use, those are capital improvements.
Like putting on a new roof versus fixing a few shingles.
Exactly. Capital improvements aren't deducted immediately. They're capitalized, meaning added to the property's basis and potentially depreciated over time. The instructions reference specific regulations like 1.263A3 that provide detailed rules on this.
Line 10 is bad debts.
This is for debts owed to your business that become worthless during the year. It has to be a business debt. And if you're a cash method taxpayer, you generally can't deduct a bad debt unless you previously included that amount in your income. You can't deduct income you never recorded.
What if it's a non-business bad debt?
That's treated differently as a short-term capital loss for the S-Corp, which then passes through on Schedule K. It doesn't go on page 1.
Okay. Line 11, rents paid.
This is for rent paid on property the S-Corp uses in its trade or business. Big warning here. You cannot deduct rent for a dwelling unit, like a house or apartment, if any shareholder uses it for personal purposes during the year.
Ah, the vacation home loophole closure.
Something like that. Also, there's a specific rule for leased vehicles. If you lease a car, truck, or van for business use and its fair market value when you started the lease was above certain thresholds, which change annually, you might have to reduce your rent deduction by including a calculated lease inclusion amount back in an income. The instructions point to publication 463 for the tables and calculation.
Got it. Line 12, taxes and licenses.
This covers state and local taxes paid or incurred in the trade or business, things like state income or franchise taxes, if applicable at the S-Corp level, property taxes on business assets, sales taxes paid on purchases if not capitalized, and business licenses. Federal import duties or excise taxes can be deducted here only if they are ordinary and necessary expenses of the trade or business.
Line 13, interest expense.
Yeah.
This sounds simple, but the instructions mention a limitation.
Yes, this is where the Section 163J business interest expense limitation can come into play. For S-Corp that aren't considered small business taxpayers, the deduction for business interest expense might be limited.
Okay, how does that limit work?
The deduction is generally limited to the sum of 1. The corporation's business interest income, 2. 30% of its adjusted taxable income, which is roughly taxable income computed without certain items like interest expense income, depreciation, etc. And 3, it's floor plan financing interest, if any.
And this limit is calculated by the S-Corp itself.
Yes, the limitation applies at the S corporation level. Any business interest expense that gets disallowed because of this limit isn't lost forever. The S-Corp carries it forward to deduct in future years, subject to the limit in those years.
But you mentioned a small business taxpayer exemption.
Right. If the S-Corp meets the definition of a small business taxpayer, it's generally exempt from this 163J limitation. To qualify, the S-Corp can't be a tax shelter, and its average annual gross receipts for the 3 preceding tax years must be $30 million or less.
So under $30 million average gross receipts, generally No interest limit worries.
Generally, yes. You aggregate receipts with related entities for that test. If you don't meet the small business test, you usually have to file Form 8990 to calculate the limitation. Schedule B has questions, 9 and 10 related to this. The instructions also list specific types of interest that are never deductible here, like interest on loans used to buy certain life insurance contracts.
Okay, moving quicker through the next few. Line 14 is depreciation, which requires Form 4562. Line 15, depletion, but not for oil and gas. It's handled differently. Line 16, advertising. Line 17, pension, profit-sharing plans. Line 18, employee benefit programs. Line 19, a specific deduction for energy-efficient commercial buildings via Form 7205. Then we hit line 20, other deductions. What goes here?
This is the catch-all for ordinary and necessary business expenses that don't have their own dedicated line. But again, remember the big caution. You cannot put items here that need to be separately stated on Schedule KK1 for shareholders. It's like charitable contributions, Section 179 expense, investment interest expense. Those have their own pass-through rules. Also, you can't deduct expenses related to tax-exempt income here. Fines and penalties paid to a government for violating the law are generally non-deductible. Other non-deductible items that might reduce book income, but don't go here, include certain settlement payments for sexual harassment if tied to non-disclosure, lobbying expenses, club dues for certain types of clubs, expenses for entertainment facilities, or travel costs for a spouse or dependent accompanying an employee unless they are also an employee with a bona fide business purpose.
What about meals? Still 50% deductible?
Generally, yes. Business meals are typically subject to a 50% limitation, provided they aren't lavish or extravagant and the S-Corp employee is present. The deductible 50% would factor into the calculation of deductions, but the non-deductible 50% portion eventually flows through as a non-deductible expense on Schedule K, line 16C, not deducted here. Also, qualified transportation fringes, like parking or transit passes provided to employees, are explicitly non-deductible by the employer.
Okay, after all that, line 22 is ordinary business income loss.
This is the bottom line from page 1, total trade or business income, less total trade or business deductions. It's a key number, but the instructions emphasize that this specific line 22 amount is not the starting point for calculating the built-in gains tax or the excess net passive income tax, if those apply. Instead, this ordinary income or loss figure flows directly to Schedule K, line 1, to be allocated to the shareholders.
Schedule B, other important information.
All right, flipping the page, we hit Schedule B, other information. This looks like a list of questions the IRS wants answered.
That's exactly right. Schedule B gathers additional details about the S Corporation's structure, activities, and compliance. Answering yes to many of these questions can trigger additional reporting requirements or flag potential issues for the IRS.
Let's touch on some key ones highlighted in the instructions. Question 3 asks about shareholders who aren't individuals like disregarded entities, trusts, estates, nominees.
If the S-Corp has any shareholders that fit those descriptions, you check yes, and you must attach Schedule B1. That schedule provides more detail on the ultimate beneficial owners behind those structures, giving the IRS transparency.
Question 4 is about the S-Corp owning stakes in other businesses.
Yes, if your S-Corp owns 20% or more of another corporation directly, or 50% or more directly or indirectly, or holds similar significant stakes, 20% or 50%, in partnerships or trusts, you check yes. You then have to provide details about each owned entity name, EIN, country, percentage owned, and if it's a 100% owned subsidiary corporation for which a Q-sub election was made.
Q-sub meaning qualified subchapter S subsidiary.
Exactly. You have to report the date that Q-sub election was made. It helps the IRS map out the corporate structure.
Question 6 talks about Form 8918 and reportable transactions. What's that about?
This asks if the S-Corp was required to file Form 8918, which is a disclosure by material advisors regarding potentially abusive tax avoidance transactions, known as reportable transactions. The instructions also remind you that the taxpayer, the S-Corp or its shareholders, might have their own obligation to disclose participation in such transactions on Form 8886, and penalties apply for failure to do so.
Question 7 is about OID, original issue discount on debt instruments.
If the S-Corp issued publicly offered debt instruments with OID, this question flags that, and it might trigger a requirement to file Form 8281, probably less common for smaller S-Corp.
Item 8 is specifically about built-in gains relevant for former C-Corp.
Very relevant. If the S-Corp used to be a C-Corp or acquired assets from a C-Corp in a carryover basis transaction, it might have net unrealized built-in gain, NUIT. This line asks for the amount of NUBIG remaining at the beginning of the tax year, reduced by built-in gains recognized in prior S years. This is important because recognizing these gains within a specific period, usually 5 years after the S election, can trigger a corporate-level tax.
Questions 9 and 10 circle back to that business interest limitation, 163J.
Right. Question 9 asks if the S-Corp made an election to opt out of the 163J limit, which is possible and irrevocable for certain real property trades or businesses or farming businesses. Question 10 then asks if the S-Corp meets the conditions that require it to file Form 8990 to calculate the limitation. As we said, if you're not a small business taxpayer, over $30 MAV average gross receipts, you generally must file Form 8990. There are other triggers too, like having excess business interest expense allocated from a partnership interest. The instructions list exceptions where Form 8990 isn't required.
Question 11 seems like a big one for simplification. Less than $250,000 in receipts and assets.
Yes, this is a key threshold. If both the S-Corp's total receipts for the year and its total assets at year-end are less than $250,000, you check yes to question 11, the benefit. The corporation is not required to complete Schedule L, the balance sheet, and Schedule M1, the book tax reconciliation. That saves a lot of work for smaller S-Corp.
Okay, question 12 asks about non-shareholder debt being canceled or forgiven.
If any debt owed by the S-Corp to someone other than a shareholder was canceled, forgiven, or had its terms modified to reduce the principal during the year, you check yes and enter the amount of the principal reduction. This doesn't automatically mean taxable income, but it flags the event for the IRS.
Question 13 is about ending a Q-sub election.
If a qualified Subchapter S subsidiary election was terminated or revoked during the year, you report that here. This has specific tax consequences, treating it like a deemed liquidation of the subsidiary.
Questions 14A and 14B are about Form 1099 filing compliance.
A simple check. Did the S-Corp make payments requiring it to issue Forms 1099, like to independent contractors? If yes, did it or will it file those required 1099s? Basic compliance check.
Question 15 deals with qualified opportunity funds, QOF.
If the S-Corporation is itself a QOF and is self-certifying, it must attach Form 8996 and check yes here, entering a specific amount from that form. This is part of the annual QOF compliance. The instructions also remind S-Corp that if they invested deferred capital gains into a QOF, they have separate annual reporting requirements, like Form 89997, until that investment is sold.
And the last one, question 16, is about digital assets.
Yep, the cryptocurrency question. It asks broadly if, at any time during the year, the corporation received, sold, exchanged, or otherwise disposed of a digital asset or a financial interest in one. A simple yes or no, for now, signaling activity in this area.
Schedules K and K1 shareholder pass-through items.
Okay, now we're getting to the real core of the S-Corp structure. Schedules K and K1, this is where the pass-through happens, right?
Absolutely. Schedule K is the summary for the entire corporation. It aggregates all the items of income, deduction, credit, etc. that aren't handled on page 1 because they need separate treatment by the shareholders. Then Schedule K1 takes that Schedule K information and divides it up, reporting each individual shareholder's pro rata share of every single line item.
So the shareholder gets their K1 and uses that info on their personal Form 1040.
Precisely. Schedule K is the corporate summary. Schedule K1 is the shareholder's specific piece of the pie.
Before we get into the lines, the instructions mention something about passive investment income potentially being reduced.
Yes, that relates back to S-Corp with prior C-Corp history and accumulated earnings and profits, AEMP. If such a corporation has too much passive investment income, like interest, dividends, rent, royalties, it might owe the excess net passive income tax at the corporate level. If it does owe that tax, the passive income items reported on Schedule K and K1 must be reduced by their share of that tax before being passed through to the shareholders.
Okay. Line 1 on Schedule K is that ordinary business income, loss. From page 1, line 22, we've covered that.
Correct. That's the main operating result flowing through.
Lines 2 and 3 deal with rental income. Line 2 is net rental real estate income, loss, often coming from Form 8825. And line 3 is for other types of rental activities. Why separated?
Primarily because of the passive activity loss rules, which often treat rental real estate differently from other rentals. Shareholders need the information broken down this way to apply those rules correctly on their own returns.
Got it. Line 4 is interest income. Is this all interest the S-Corp receives?
Not necessarily. This line is generally for portfolio interest earned on investments, bank accounts, things not directly part of the core business operations. If the S Corp earns interest in the ordinary course of its trade or business, like a business whose job is lending money, or interest on customer accounts receivable if charging interest is normal for that business, that interest would likely be part of the ordinary business income on page 1, not here on Schedule K.
So this is more like investment interest.
Mm.
What about line 5, dividends? 5A is ordinary, 5B is qualified.
Right. Ordinary dividends on 5A are typically portfolio income. Qualified dividends on 5B are those eligible for lower capital gains tax rates for the individual shareholder. They have to meet certain criteria, like being from domestic or qualified foreign corporations and meeting holding period requirements.
Do all dividends count as qualified?
No, the instructions list several exceptions. Dividends from certain short sales, dividends where the shareholder doesn't meet the holding period, certain dividends from REITs or mutual funds that don't pass through the qualified status, dividends from passive foreign investment companies, PFICs. Those would just be ordinary dividends. If qualified dividends come from foreign sources, that might trigger K2, K3 reporting.
Okay. Line 10 is other income loss, another catch-all.
Sort of. It's for income or loss items that don't fit the categories above but still need separate reporting. A big one here is Section Wealth 31 gain or loss from selling business property held long term. Also, income from activities that aren't considered a trade or business for QBI purposes might land here, like casual gambling winnings or income from a hobby-like activity. Specific items from Roniemic investments also get reported here via attachment, and this is also where certain foreign income items might appear, like GILTI or Subpart F inclusions. But there's a key rule change. For foreign corporation tax years starting on or after Jan 25, 2022, S-Corp generally don't have these inclusions unless they made a specific election under proposed regulations to be treated as owning the foreign stock directly. If they do have these, K2, K3 reporting is likely needed.
Let's switch to the deductions section on Schedule K, starting around line 11. Line 11 is the Section 179 deduction.
Right. This is the election to expense certain business property immediately instead of depreciating it. The S-Corp calculates the potential deduction on Form 4562, determines how much passes through, and reports the shareholder's share here. The limitation on how much can be deducted applies at both the S-Corp level and the shareholder level.
Lines 12A and 12B are charitable contributions, split between cash and non-cash. Why separate?
Because the shareholder's deduction for charitable contributions is limited based on their own adjusted gross income, AGI, and the limits can differ for cash versus non-cash donations, they need the amounts separately.
Line 12C is investment interest expense.
This is interest paid on debt used to carry investments like margin interest to buy stocks. Similar to charity, the deductibility is limited at the shareholder level based on their net investment income, so it's reported separately.
Line 12 is Section 59E2 expenditures.
These are certain costs, like research or intangible drilling costs, that taxpayers can elect to amortize over 10 years instead of deducting currently. If the S-Corp makes this election, the amortizable amount passes through here.
Line 12E is other deductions. What lands here?
This is for deductions that don't fit elsewhere but need separate reporting. The instructions list several. Section 212 expenses for producing income that aren't trade business or portfolio expenses, foreign taxes paid or accrued, shareholder chooses deduct or credit, so reported separately, often with code L and on K3. Intangible drilling costs, not capitalized. Soil and water conservation expenses, certain reforestation costs. The instructions also specifically mention pre-productive period expenses with code M. For farming businesses, shareholders might be able to elect to deduct costs for plants with long growing periods currently, rather than capitalizing them. Since it's a shareholder election, the S-Corp reports the expense amount here.
Any other common codes under other deductions?
Yes, Code X for certain film, television, and theatrical production costs eligible for immediate expensing, up to limits. Code Y for expenditures to remove architectural barriers for the disabled or elderly, Section 190. And Code Z, labeled itemized deductions.
Itemized deductions on a business return. How does that work?
It sounds odd, but Code Z is for expenses paid by the S-Corp that would be itemized deductions for an individual shareholder if they paid them directly for the same purpose, and they aren't reported elsewhere, like investment expenses on 12C or trade business expenses on page 1. An example might be certain Section 212 expenses not related to portfolio income, but things like non-deductible travel for conventions. Those are just non-deductible, reported later.
Okay, there are other codes too, like for capital construction funds, AA, penalties on early withdrawal of savings, AB, and interest expense allocated to debt finance distributions, AC. Moving on to line 13, credits.
Right, this section passes through various business tax credits shareholders might be able to claim. Lines 13A are for the low-income housing credit, split by type. If there are multiple LIHC properties, details need to be attached. Lines 13C, D, and E cover other rental-related credits. Line 13F is the biofuel producer credit.
And then line 13G, other credits, looks like a huge category.
It is. The instructions list dozens of potential credits with specific codes. Just a few examples. Disabled access credit, code AE. Various credits for small employers related to retirement plans or health insurance, codes AE, AF, AGBA. Employer-provided child care credit, AH. Energy investment credit, AI. Railroad track maintenance credit, AJ. Energy efficient home credit, AM. Alternative motor vehicle or refueling property credits, AN, AO. New or commercial clean vehicle credits, AYAZ. Employer credit for paid family and medical leave, BB.
That's a lot. And a newer one, code BC.
Yes, that's for eligible credits the S-Corp received from another taxpayer via transfer under Section 6418, the new credit transferability rules.
Yeah, credits from things like clean renewable energy bonds or Build America bonds have a unique reporting. The amount of the credit gets reported as interest income back up on Schedule K, line 4, and it's also treated as a property distribution reported down on Schedule K, line 16.2. It's calculated on Form 89I. Also listed here are credits for carbon oxide sequestration, code AEW, and recapture, code AX. Okay, last big section on Schedule K, line 16, other items.
This covers miscellaneous items affecting shareholder basis or requiring reporting. Line 16A is tax-exempt interest income increases basis but isn't taxed.
Line 16B is other tax-exempt income. What goes here?
The big one mentioned in the instructions is tax-exempt income from the Forgiveness of Paycheck Protection Program, PPP loans. If a PPP loan was forgiven during the tax year, the forgiven amount goes here. Requires an attached statement.
Line 16C is non-deductible expenses.
This is where expenses that reduce the company's books but aren't deductible for tax purposes land. Think expenses related to tax-exempt income, the non-deductible portion of meals, fines, penalties, lobbying costs. Crucially, the instructions say that expenses paid this year with forgiven PPP loan proceeds are reported here as non-deductible. This connects directly to Schedule M2's treatment. Also, payments made by the S-Corp to buy tax credits via transfer under Section 6418 are treated as non-deductible expenses reported here.
Line 16D is distributions.
This reports the total cash and fair market value of property distributed to shareholders during the year, vital for tracking basis and potential taxable distributions.
Line 16 is repayment of loans from shareholders.
If a shareholder previously loaned money to the S-Corp, any principal repayments made by the S-Corp back to the shareholder go here, affects the shareholder's basis in that loan.
Line 16 is foreign taxes paid or accrued.
Reported separately, again, so the shareholder can choose on their 1040 whether to deduct them or claim the foreign tax credit.
The instructions also mention reporting for PFICs.
Yes, passive foreign investment companies. If the S-Corp owns PFIC stock and certain rules apply, it needs to provide information to shareholders about things like excess distributions or gains on sale, usually via attachment or Schedule K3.
Now, a huge topic often reported in Box 17 or 20 of the K1 using code V is the Section 1999 or Qualified Business Income, QBI, deduction information.
Absolutely critical for many S-Corp shareholders. The QBI deduction itself, that potential 20% deduction, is calculated by the shareholder on their personal return. But the S-Corporation must provide all the necessary pieces of information for them to do that calculation.
So the S-Corp does the groundwork.
Exactly. The S-Corp reports, usually on an attached statement like Statement A, the shareholder's share of qualified items of income, gain, deduction, and loss, W-2 wages allocable to that income, the unadjusted basis immediately after acquisition, UBIA, of qualified property used in the businesses, any qualified items from publicly traded partnerships, PTPs, and any Section 199A dividends, like from REITs.
And this needs to be broken down.
Yes, very specifically. It must be broken down by each separate trade or business the S-Corp conducts. And the S-Corp must also identify if any of those trades or businesses are specified service trades or businesses, SSTBs like health, law, accounting, consulting, etc., because the QBI rules are different for SSTBs, especially for higher income shareholders.
So the S-Corp determines what might be QBI, wages, UBIA for each business line, and passes that through.
Correct. The S-Corp identifies the potential QBI components. The shareholder then uses that info, combined with their overall taxable income and other factors, to calculate their actual deduction. The S-Corp also needs to report if it has aggregated multiple trades or businesses for QBI purposes on a Statement B and pass-through QBI info received from other pass-through entities it invests in.
How does the S-Corp know if something is a qualified trade or business?
The S-Corp makes that determination based on Section 162 standards generally, an activity conducted with continuity and regularity for profit. It explicitly excludes being an employee, and for QBI purposes generally excludes SSTBs, though shareholders below certain income thresholds can still get QBI from SSTBs. The S-Corp determination of whether an activity is a trade or business is binding on the shareholders.
Are there other codes on the K-1 beyond QBI?
Yes, plenty. Box 17 or 20 might have codes like AA for excess taxable income or AB for excess business interest income if Form 8990 was filed. AC for gross receipts, info needed for other tax calculations. AJ for information related to the excess business loss limitation that applies to individuals. AN for farming fishing income details.
This leads naturally into the at-risk and passive activity limitations. These apply to the shareholder, not the S-Corp directly.
Correct. Both the at-risk rules, Section 465, and the passive activity loss rules, Section 469, limit the shareholder's ability to deduct losses or use credits. They don't limit the S-Corp itself. However, the S-Corp's crucial role is to provide the necessary information on the K-1 attachments separately for each distinct activity so the shareholders can apply these complex rules.
Okay, briefly, what are the at-risk rules about?
They prevent shareholders from deducting losses exceeding the amount they have at risk in the activity. Generally, that's their stock basis, plus any debt they are personally liable for. The S-Corp needs to report income loss separately for activities subject to these rules, like farming, oil, gas, equipment leasing, and a catch-all for other businesses. There are rules about whether multiple other business activities can be aggregated into one for at-risk purposes, and the S-Corp checks box J1 if it has aggregated.
And the passive activity limitations, PL rules.
These are generally broader. They prevent taxpayers from deducting losses or credits from passive activities against non-passive income, like wages or active business income. Again, shareholder-level limit. The S-Corp must report income loss credits separately for each activity.
What makes an activity passive for a shareholder?
A trade or business activity is passive for a shareholder if they do not materially participate in it. Material participation involves regular, continuous, and substantial involvement. Rental activities are generally considered passive by definition, regardless of participation, although there's a major exception for qualifying real estate professionals.
So the S-Corp needs to break down its operations into different activities.
Yes, it needs to separately identify trade or business activities, rental real estate activities, and other rental activities. Even within trade or business activities, which are netted on page 1, it needs to provide the detail per activity on K-1 attachments so each shareholder can apply the material participation tests. Portfolio income, interest, dividends, is not passive income and is reported separately.
Can the S-Corp group multiple operations into a single activity for PL purposes?
Yes, under certain conditions. Activities can be grouped if they form an appropriate economic unit, based on factors like similarity, common control, location, interdependence. The instructions give examples. Once a grouping is made, it's generally binding for future years. There are restrictions on grouping rental with non-rental activities or grouping certain limited partner interests. The S-Corp checks box J2 if it has grouped activities.
And recharacterization of passive income.
That's a complex rule where income that looks passive might be treated as non-passive in specific situations, like renting land or certain self-rental scenarios. The S-Corp's job here is mainly to identify on K-1 attachments any activities that might be subject to these rules, putting the shareholder on notice.
So for both at-risk and PL, the S-Corp's job is data provider, detailed data broken down by activity.
Exactly. Provide the inputs so the shareholder can run the calculations.
Schedules M1 and M3 income reconciliation.
All right, let's look at the M schedule. Schedule M1 and Schedule M3 seem to be about connecting the company's books to its tax return.
That's their purpose. They reconcile the net income, or loss, reported on the S-Corporation's financial accounting records, like for JAP, with the income or loss reported for tax purposes on the return, specifically on Schedule K. Differences arise because tax accounting rules often differ from book accounting rules.
Does every S-Corp have to file one of these?
Schedule M1 is generally required, unless the S-Corp meets that small corporation exception we talked about, total receipts and total assets, both under $250,000. Schedule B, question 11, is yes. If you meet that, No M1 or L is needed.
Okay, and Schedule M3.
Schedule M3 is required for larger S corporations specifically if the S corp's total assets at the end of the tax year are $10 million or more. If you're below that threshold, you can choose to file M3 voluntarily, but it's not required.
Is there a middle ground if you have to file M3 but aren't huge?
Yes, there's a special rule. If you're required to file M3 but have total assets under $50 million, or if you're filing M3 voluntarily, you have an option. You can either fill out the entire M3, parts 1, 2, and 3, or you can just complete part 1 of Schedule M3 and then complete the simpler Schedule M1 instead of M3 parts 2 and 3. If you do that, line 1 of your M1 must match line 11 of M3 part 1.
So what does Schedule M1 actually do? How does it reconcile?
It starts with the net income loss per books on line 1. Then it adds back things that reduce book income but aren't tax deductions, like 50% of meals, federal income taxes at book, penalties, and adds income reported for tax but not booked yet, lines 2 and 3. Then it subtracts income included on the books but not taxed, like tax-exempt interest, and deductions taken on the tax return but not charged against book income this year, lines 5 and 6. The result on line 8 should tie back to the total income loss reported on Schedule K.
Can you give an example of a common M1 adjustment?
A classic one is line 3B, travel and entertainment. This is where you'd add back expenses recorded on the books that aren't deductible for tax, the non-deductible 50% of meals, any strictly non-deductible entertainment costs, non-deductible club dues, fines, penalties, lobbying costs, etc. They reduce book income, but tax law disallows them, so they get added back here.
And Schedule L, the balance sheet, also tied to the $250K threshold.
Exactly. If you don't meet the under $250K threshold, meaning you answer no to Schedule B, question 11, you must complete Schedule L. And the total assets figure reported on page 1 of Form 1120S, item F, must match the total assets shown on Schedule L, line 15, column D.
Schedule M2, analysis of equity accounts.
Okay, last major schedule, Schedule M2. This looks unique to S-Corp and seems really important for distributions.
Schedule M2 is absolutely crucial. Its full title is Analysis of Accumulated Adjustments Account, Shareholders' Undistributed Taxable Income, Previously Taxed, Accumulated Earnings and Profits, and Other Adjustments Account. It tracks the S Corporation's equity accounts for tax purposes, which directly impacts how distributions to shareholders are taxed. These accounts are tracked at the corporate level, except for PTEP.
4 accounts listed there in the columns: AAA, PTEP, AEMP, and OAA. Let's break those down. First, AAA.
The Accumulated Adjustments Account, or AAA, is generally the most important equity account for an S-Corp, especially one that's always been an S-Corp. It basically tracks the cumulative amount of the S-Corp's taxable income that has already been passed through in tax to the shareholders but not yet distributed. It starts at 0 for a new S-Corp.
How does the AAA balance change?
There's a specific ordering. First, it's increased by the S-Corp's income items, except tax-exempt income and excess depletion. Second, it's decreased by deductible losses and expenses, non-deductible expenses, but not those related to tax-exempt income, and shareholder depletion for oil gas. There's a nuance here called the net negative adjustment rule.
Uh-oh.
If the total decreases in Step 2 are more than the total increases in Step 1, that excess decrease is called a net negative adjustment. You don't take it into account yet. Third, AAA is decreased by distributions made during the year, but not below 0. If distributions exceed the AAA calculated before considering the net negative adjustment, AAA is reduced to 0. Fourth, after accounting for distributions, any net negative adjustment from Step 2 is applied, potentially driving AAA negative.
Whoa, okay. So distributions come out before a net loss for the year fully hits AAA.
Effectively, yes, in terms of calculating the AAA available for distribution. The instructions have an example showing this clearly. A positive AAA balance can be distributed tax-free, up to basis, even if the corporation has an overall loss for the year, creating a net negative adjustment. That adjustment reduces AAA after the distribution is accounted for.
Got it. What's the next column? PTP.
Shareholders' undistributed taxable income previously taxed. This is mostly historical, relating to S-Corp rules before 1983. If an S-Corp existed back then and had undistributed taxable income, shareholders might have a PTEP balance. It's personal to each shareholder and can't be transferred. Most S-Corp formed after 1982 won't have anything in this column.
Okay, column C. Accumulated earnings and profits, AEMP. Sounds like a C-Corp thing.
It is. AEMP only exists if the S-Corp was previously a C-Corp or acquired a C-Corp with AEMP. It represents the earnings generated during the C-Corp years that were never distributed. While it's an S-Corp, this account generally only decreases for dividend distributions, specifically designated as coming from AEMP, or certain stock redemptions or reorganizations.
Why does tracking AE&P matter for an S-Corp?
Two big reasons. First, distributions from A&P are treated as taxable dividends to shareholders, unlike distributions from AAA. Second, if an S-Corp has AE&P and significant passive investment income, it can trigger that corporate-level excess net passive income tax, so knowing if you have AE&P is critical.
Last column, D, the other adjustments account, OAA.
OAA tracks items that affect shareholder bases but don't hit AAA or AE&P. The main things are tax-exempt income, like municipal bond interest or PPT forgiveness, and the expenses related to earning that tax-exempt income. Distributions can also reduce OAA, but only after AAA, PTEP, and AE&P have all been reduced to zero.
How exactly does PPP loan forgiveness fit into M2? You mentioned it for OAA and AAA.
Right, the instructions get specific. Tax-exempt income from PPP forgiveness increases OAA, line 3, col D. Expenses paid this year with forgiven PPP proceeds decrease OAA, line 5, col D. Now, if those same expenses also reduce book income and are flowing through as deductions that decrease AAA, like on line 5, col, they create both an increase to AAA, line 3, col, backing out the non-deductible aspect for AAA, and a decrease to OAA, line 5, collecting the cash outflow funded by tax-exempt income. It's a bit complex, but ensures basis is adjusted correctly.
Okay, so these four accounts dictate how distributions are taxed. What's the order?
The distribution ordering rules are key. Generally, cash or property distributions are treated as coming from 1. AAA, first. Reduces AAA, but not below zero. Tax-free up to shareholder basis. 2. P2P, second. Reduces shareholder-specific P2P balance, also tax-free up to basis. 3. AE&P, third. Reduces AE&P. These distributions are taxable dividends to shareholders. 4. OAA, fourth. Reduces OAA, generally tax-free up to basis. 5. Return of basis, fifth. Reduces any remaining shareholder stock basis, tax-free. 6. Capital gain, finally. Any distribution beyond basis is typically capital gain.
So AAA and OAA distributions are generally good, tax-free return of capital previously taxed income, while AE&P distributions trigger tax.
That's the crucial takeaway. Managing distributions to come from AAA first is usually the goal, especially if AE&P exists.
Can you choose to distribute from AE&P first?
Yes. S-Corp with AE&P can make elections to alter the order. You can elect to bypass PTEP or even make an election to treat distributions as coming from AE&P first, called a deemed dividend election sometimes. These require shareholder consent and specific procedures, but can be useful for clearing out taxable AE&P strategically.
The example in the M2 instructions seems to pull all this together.
It does. It shows how income, losses, tax-exempt items, and distributions flow through and adjust the AAA and OAA balances, illustrating the ordering rules and the impact of things like net negative adjustments. It really emphasizes why careful tracking of these accounts throughout the year is so important. Outro. So as we've walked through this Form 1120-S and dug into the instructions, it's pretty clear it's more than just filling in boxes. It maps out the entire financial life of the S-Corp for tax purposes, from the core business results on page 1.
Right, the day-to-day operations.
To the incredibly detailed pass-through items on Schedules K and K1, covering everything from simple interest income to complex QBI components and foreign activity reporting. And then, critically, Schedule M2 tracks those equity accounts that dictate how shareholders are actually taxed on distributions.
Yeah, it's intricate. The level of detail, especially on K and K1, needing to break things down by activity for passive loss rules or providing all those QBI pieces, it really shows how much information flows from the corporation to the owner's return.
Exactly. It highlights the transparency required. The instructions reveal just how interconnected the corporate-level reporting is with the shareholder-level tax outcomes. You have to track everything meticulously: officer comp reasonableness, the 163J interest limit if it applies, how PPP forgiveness impacts OAA, and AAA, the distribution ordering.
So, for our listeners, what's the big picture here? I mean, perhaps the most striking thing is just how much the IRS wants to know about the inner workings.
Yeah.
How you classify income, how you group activities, handling specific transactions like digital assets. It's not just about the bottom line number.
That's a great point. It underscores that while the S-Corp avoids double taxation, it comes with its own set of complex tracking and reporting burdens. You need specific expertise to navigate it correctly, ensuring everything flows through properly, from the 1120-S to the shareholders' K1s and ultimately their 1040s.
Definitely gives you a lot to think about regarding the complexities of business taxation and entity choice. Thanks for joining us for this deep dive into Form 1120-S.